Okay, so get this right. You know how we've been talking about really diving deep into the world of intraday futures trading? Well, you sent over this YouTube video from a trader who calls himself the Inner Circle Trader. And honestly, it's like he's claiming he's found the Holy Grail, a foolproof system for raking in the points.
Oh, yeah. These videos always grab you with these promises of massive wins, don't they?
Seriously. And this one, well, he doesn't hold back. He throws up his Thinkorswim account on the screen for everyone to see, and boom, the first thing he highlights, this huge winning trade on the NASDAQ E-mini futures.
And we're not talking small potatoes here, right? This is over 100 points on the NASDAQ.
No kidding. He's like, look at this, folks. This is what I'm talking about. He even makes a point of saying he's not interested in those tiny tick-by-tick gains. He's all about these big moves. I have to admit, it's pretty attention-grabbing.
Of course it is. Who wouldn't be drawn to that?
Right. But at the same time, you know, that little voice in the back of my head starts whispering, hold on a sec. Whenever someone leads with their biggest win right off the bat.
It's like they're saying, hey, look, this one time, everything went perfectly. But they never show you the other trades, the losses, all the messy stuff that comes with trading, especially when you're dealing with something as volatile as intraday futures.
Totally. And to be fair, he does mention risk, kind of in passing. He talks about starting small with a micro account. But then he launches into this whole independence thing, saying you don't need those fancy signal services or expensive software. All you need is his system.
Ah, the classic, I've got the secret sauce pitch.
Yay.
It's tempting, I'll give him that. But here's the thing. Even if he does have some magical system, the market is a wild animal. It doesn't care about systems, and there are just too many factors at play.
So true. But okay, let's get into it. He starts with a weekly analysis, focusing on the NASDAQ mostly, though he mentions the S&P and Dow E-minis too.
Makes sense, right? A lot of these traders gravitate toward one instrument they feel comfortable with. And the NASDAQ, with all those tech stocks, it's known for its wild swings.
And those swings, well, that's where the opportunity is, or so they say.
Right, but it's a double-edged sword, isn't it?
Hmm.
More volatility, more chance of a big win, but also a higher chance of some pretty nasty losses.
True, true. Risk and reward, two sides of the same coin. He uses this interesting analogy to describe his weekly approach. He talks about figuring out where the market is naturally drawn to, like a paperclip being pulled by a magnet.
I like that analogy. It's a good way to think about support and resistance levels, those price points where the market seems to reverse course, almost like it's being pulled back by some invisible force. And then he brings in the concept of seasonality.
Seasonality. Now, that's not something you hear every day in trading, is it?
Not really, but it's an interesting concept that often gets overlooked. Seasonality refers to those recurring patterns in the market, where prices tend to move in a certain direction during specific times of the year. Like historically, certain months or quarters might be bullish for a particular asset, while others might be bearish.
So it's like the market has its own internal calendar or something.
You could say that. Some traders believe that by understanding these seasonal patterns, they can get a bit of an edge in the market.
Fascinating. So he lays out his weekly analysis, emphasizing those support and resistance levels, this seasonality idea. Then he zooms in on the daily chart. Yeah.
Exactly. But he stresses over and over, don't look at the daily chart in isolation. You got to see it within the context of that overall weekly trend. And in this specific case, his analysis was pointing towards a bearish market, meaning he expected the NASDAQ to move lower overall.
Right. And to illustrate this, he actually overlays those levels he's identified on the weekly and daily charts onto the hourly chart. It's like he's creating this roadmap of where the market might go.
Exactly. He's establishing his bias, which is crucial in trading. You can't just jump in randomly. You need to have some kind of reasoned assumption about where the market might be headed. And his bias, at least in this instance, is bearish.
He seems particularly interested in those levels where big orders, or liquidity as he calls it, might be sitting.
Liquidity is everything in trading. It basically refers to how easily you can buy or sell an asset without causing a massive price change. Lots of liquidity usually means there are big players, institutions lurking around.
Gotcha. So these high liquidity areas are like the watering holes where the big animals hang out.
That's a great way to put it. And this is where it gets really interesting. He believes that by pinpointing these liquidity zones, traders can anticipate the moves of these smart money players and potentially profit from their actions.
Because, as they say, the trend is your friend, especially when that trend is being driven by a whale.
Something like that. He even uses the term stop hunts to describe how some traders try to trigger these large orders and create even bigger price swings.
Hold on. Stop hunts. You're going to have to break that down for me.
Okay, so imagine this, right? The market's looking like it wants to go down. But there's this group of traders who want to push the price up just a little bit, just enough to trigger all those buy stop orders from traders who are betting on the price going even higher.
So they're setting a trap, basically.
Exactly. Once those buy stop orders are triggered, the market gets flooded with buy orders and boom, a quick surge in price. But then
And then?
the rug gets pulled out. The market reverses course, taking out all those traders who got caught in the stop hunt. Ouch,
Yeah.
right?
Brutal. But that's where the opportunity is, according to our inner circle trader.
Apparently. At least that's how he sees it.
Mm.
But let's see if his strategy holds up to a little more scrutiny, shall we?
All right, so walk me through this whole fair value gap thing. Like, what am I looking for on the charts?
So
Yeah.
he actually zooms in even further from that 15-minute chart to a 2-minute chart, really trying to pinpoint things. He's looking for the specific sequence of events, and he calls the first event a break in market structure. Basically, in this case, it's a small move down, pushing the price just below a recent low.
Okay, so it's like the market is giving us a little signal like, hey, pay attention, things are about to get interesting.
Yeah, exactly. A little heads up. And this is where his fair value gap comes in. He points to this candle on the 2-minute chart where the market briefly trades higher. And that creates this gap between the high of that candle and the low of the one right before it. That, my friend, is the fair value gap, an imbalance that he believes the market wants to correct.
Hold on, let me make sure I'm following you. So he's saying this tiny little gap on a 2-minute chart. After that break in market structure, that's like a secret signal that the market's about to make a move. And not just any move, a move down, since he's looking to short, right?
You got it. He's betting that when the price trades back up into that fair value gap, it's the perfect time to enter a short trade. And why? Because, according to him, those algorithms that control everything are going to push the price back down to fix that imbalance.
Algorithms again. He seems really fixated on the idea that algorithms are the ones really in control.
Well, there's no denying that algorithms play a huge role in the market these days. They execute trades faster than we can even think, analyzing data and making decisions in milliseconds. But it's important to remember, they're still just tools following the rules set by their programmers.
So less like puppet masters and more like really, really fast puppets.
Exactly. They respond to things like order flow, news events, economic data, all sorts of factors that can move the market. But they're not some sentient beings, intentionally trying to manipulate things for their own gain. At least I don't think so.
Okay, that makes me feel a little better. But it still sounds like understanding how these algorithms work could give you a real advantage.
Right, and that's what he's suggesting, isn't he? And I have to admit, the example he uses, the price does drop significantly after that fair value gap appears.
And he doesn't let us forget it. He even calls this whole setup his ATM machine. I mean, okay, bit of an exaggeration maybe.
Maybe just a tad.
Yeah.
But you can see why he uses that kind of language, right?
Yeah.
It's appealing, the idea of having this system that just spits out profits.
Totally. But the question is, can this fair value gap really live up to the hype?
That's the million-dollar question, isn't it?
Yeah.
I mean, one carefully chosen example doesn't exactly prove a whole system. So what else does he have up his sleeve to convince us?
Right, exactly.
Well, he brings in this thing he calls a liquidity matrix. Basically, it's a way to pinpoint potential price targets using the day's high and low as reference points. And how does he do this? With the help of the Fibonacci retracement tool, of course. He draws this line from the day's high to the low, then focuses on that 50% level.
Okay, so if the price is above that 50% level, it's like, what? It's on sale. A discount.
Actually, it's the opposite. He considers prices above the 50% level to be premium, meaning they're more expensive, overvalued even. And since he's looking to short, ideally, he wants to see that price drop from premium to discount. And guess where he thinks those stops those orders to sell when the price drops to a certain level might be clustered?
Let me guess. In that bargain bin for short sellers.
Bingo.
Yeah.
In this case, he points out a previous low and another fair value gap that formed earlier in the day as potential targets.
Get out. 2 fair value gaps in one day. Talk about lucky.
Yeah.
So what happens next? Does the market actually cooperate and make this guy look like a genius? And wouldn't you know it, the price just takes this nosedive, plunges right through that 50% level, glows past his previous low target, and bam, right into that earlier fair value gap he was eyeing. I mean, come on, it's almost too perfect. like it was scripted or something.
It does make you wonder if he's maybe, chosen a particularly good example to make his system look amazing.
Yeah.
But here's the thing. Even if he is doing a little cherry picking, there are some valid points he's making.
Okay, like what? What stood out to you, even if you're not ready to crown this fair value gap the king of all trading strategies?
Well, take those breaks in market structure he talks about. That's a real thing in technical analysis. Traders use it all the time to spot those shifts in momentum, those hints that a trend might be about to reverse. It's not just some made-up term.
And what about those liquidity zones, those areas where the big orders are hanging out?
Totally legit. If you're trading, especially intraday futures, understanding order flow and how it can move the price is critical. It's not something you can just ignore.
So it's less about whether this fair value gap thing is some kind of magic bullet and more about the fact that he's using these fundamental trading concepts that actually hold water.
Exactly. He's basically put together a system, a framework for approaching the market using these elements. Now, whether that system is going to work consistently in the long run, well, that's up for debate. But those underlying principles, those are solid.
And that's what it really comes down to, right? I mean, anyone can cherry pick a few winning trades and make themselves look like a trading god. But without seeing the bigger picture, his track record over time, it's impossible to know if this fair value gap system really delivers.
That's the thing with these systems, right?
Yeah.
The market is always changing. What works today might not work tomorrow. And he does say, I'll give him credit, that this isn't some get-rich-quick scheme. Remember what he said, and I'm paraphrasing here, I'm not guaranteeing you'll make millions.
Yeah, but then he goes on to show us his Thinkorswim account, right?
Yeah.
All those impressive numbers, all that profit. It's like he's dangling that what if in front of us, suggesting that, hey, maybe with enough practice, we could be swimming in cash too, especially with the kind of leverage you get with full futures contracts.
I mean, who wouldn't be tempted by that? The powerful image, right? Turning a small account into a life-changing amount of money.
It's the dream. But he does also emphasize risk management. Starting small, those crucial things, even if it feels like he kind of rushes through them.
Right, he mentions position sizing, using stop-loss orders, all the things you need to know to protect yourself. But I agree, he doesn't really go into much detail, which is kind of a red flag for me.
It's like he checks the box, like, okay, gotta mention risk management, gotta tell him to be careful, but then it's right back to those fair value gaps in his ATM machine setup.
And that's what worries me about new traders. They see this exciting strategy, this potential for big wins, and they forget about the fundamentals. They might jump in head first, risking more than they can afford to lose without really understanding how to protect themselves when things inevitably go south.
So where does that leave us? We've gone through his claims, broken down his strategy, and I have to say that fair value gap thing, it's intriguing. But without seeing more data, more real-world results, it's hard to know for sure if this is a winning formula or just another flashy system that might work sometimes.
And that brings us to the question we'll leave you with today. This trader claims his system frees you from relying on others, that it puts the power back in your hands. But in this day and age, where news travels at the speed of light and algorithms are making trades faster than we can blink, can any trader truly be independent? Or are we all, to some extent, influenced by this constant stream of information and the actions of others? It's something to think about as you navigate the exciting and, let's face it, sometimes overwhelming world of trading.